Here we go. Welcome everybody to the December 2023 market update featuring the expertise of your own Mike Ott. I'm Cindy Bishop with Cindy Bishop Worldwide. Our distinguished speaker, Mike Ott, brings a wealth of experience to the table with a background as a former public school teacher and an impressive 19-year tenure in the mortgage industry. Mike has earned a stellar reputation. His unique educational approach and unwavering commitment to excellence have endeared him to both clients and agents alike. Me too. I love Mike's market update. Mike's profound understanding of the intricate nuances of the market, coupled with his unparalleled attention to detail, make this market update an indispensable resource for agents seeking to stay ahead of the curve. Also, the reason we have it later in the month now is because Mike is a real good study of all of the tools he needs to bring you the best information, which impresses me a lot. As a senior home loan consultant at First Heritage Mortgage, Mike is well versed in the intricacies of the industry. Additionally, his status as a highly regarded and sought after trainer with us further underscores his expertise because we're super picky. Please join us in extending a warm welcome to our presenter for today, the one and only Mike Ott.
Thank you, Cindy. Good afternoon, everybody. All right, December 2023, nearing the end here. All right, so let's talk rates first. If you've been in tune with the market, interest rates have had a real good November. You know, a month ago when we were doing this, we were talking about interest rate ranges on a variety of the loan products that were up there scratching in the low 8s. We've seen that mortgage-backed securities and the 10-year Treasury moving in a more favorable direction based on some of the economic data that's come out. We're going to talk a little bit more in depth on those items that have come out since we last met. But overall, we've had a really good run. I'll show you the mortgage-backed securities chart here in a second. But for conventional financing, your conforming loan amounts were in a range of 6 3/4 to 7 1/4. The high balance and the jumbo stuff is usually a tad bit higher than that. So we're seeing that run between 7, 7.5. And the govies are in a 6.5 to 7% range. I always put on here mortgagenewsdaily.com. It's a place where, you know, just anybody can go. The general consumer can go. It's not a membership site. It's not a paid for subscription, but you can go on and you can kind of track. They do a really neat tracking of the national average on the loan products. You know, if you went in there today, I think they were reporting like 7.1 on the 30-year fixed conventional loan. But that's a really good resource to kind of just keep up with the here and now rates. You know, we obviously rates move drastically in one direction or the other. There's usually a media outlet that's, you know, running with it in some way, shape, or form. What always gets me and that I find comical is that they're usually, you know, by the time they report the news that rates have dropped, 2 or 3 business days have gone by and the market's happened, right? And the market does what it does. And it's, you know, and we've, you know, we're completely different 3 days from that time frame. Because you usually get the calls like, hey, I heard rates drop. Like, yeah, that was the end of last week. And now we're in the middle of this week and things have, you know, gone back to where they were. So always the fluctuations in the market. And one thing that definitely does fluctuate for us is the mortgage-backed securities. So here's a snip of the Fannie Mae coupon. For those of you that have been coming, I usually like to put this chart up, and not to get you to be necessarily a student of the market, but you've got your candlestick chart here. And I obviously wanted to draw attention from, you see kind of the October 20th range, end of October, mortgage-backed securities have been on a steady incline here in terms of price. Now, the thing to keep in mind is that price is inverse to rate. So when the price goes up on a mortgage-backed security, the rates offered to consumers go down. Okay, so this was nice because last month when we looked at this, we were on the other side of this chart and we were watching this price go down and the rates go up and, you know, push into the low 8s. So we've had a really good November. I also like to point out that, you know, this stuff is never linear. And you've got all these other goofy lines going across here and stuff like that. And there's resistance levels, support levels. The one I left on is the blue line that kind of runs through there, that light blue line, and that's the 200-day moving average for the coupon. And as you can see, and I put a little circle, we've had a pretty good run up, and now we've kind of stalled and puttered out a little bit, but that 200-day moving average is showing signs of being a very strong level of support when it comes to the technicals of these mortgage-backed securities. So we had news today, CPI for inflation data. We'll get to that in a second. It didn't really help us. It evidently hasn't hurt us either. And we were kind of expecting maybe some lower inflation numbers, but we didn't get them. The report met expectations, and we're kind of caught right in that zone there, what is encompassed by that circle there. And then we've got the Fed meeting coming up tomorrow. All right, well, let's talk about some of this economic news that we've had since we last met. And I'll change this before I send this out. That PCE, that would have been October's PCE that was given to us in November. It's not September, that's October. The data is correct, the month is not. So PCE is the Fed's favorite measure of inflation. And that report came out at the end of November, and it showed inflation was kind of flat and down, to 3% from 3.4 on the overall headline number. Now, this core rate that this is the Fed's favorite measure because the core rate strips out food and energy, and that decreased 0.2 to 3.5 year over year, and that was down from 3.7. So that PCE was a report that we saw when we got it at the end of November, that we like this trend, right? We like to see this inflation data that the Fed's paying so much close attention to moving in our favor for those of us in this industry. Rates track with inflation, not necessarily the individual moves that the Fed makes to the federal funds rate, but this is what they watch. So when we get a good reading like this, we're pleased to see it. And what's neat is if you annualize the PCE over the last 6 months, inflation is that's an average of 2.4. And remember that every time the Fed beats the drum, their target is always 2%. So that, last 6 months reading averages, we're getting much closer to where they want us to be. The next two, the ADP employment report came out on December 6th, and the November BLS jobs report was just last Friday. These two have been contradictory for quite some time. You see the ADP report, 130,000 job creations were expected, but we only got 103,000. So again, that's signs, that data is indicative of the economy cooling. People aren't hiring. There aren't as many job openings. That's right. The economy is basically constricting with numbers that look like that and are trending that way. Well, then, a week or 2 days, 2 days later on Friday, we get the BLS jobs report, and we beat expectations on that. And there's been a lot of controversy over the modeling that they use for this, and why is there such a big disconnect, to the point now where the market, we really don't know what to make of this, or we always have to almost wait till the next month because then they revise the previous number, and the revisions have been down. As you can see, the previous was 336, and it was revised down to 297. So the fact that we're coming down, on that jobs number, that's from month over month, is another sign. Although the one blip on the radar that was unexpected, we thought we would see the unemployment rate actually get and start with a 4 and get to 4.0. And it didn't. It actually went down to 3.7. But again, a lot of that is in the modeling. The people that are out of a job, that quit seeking employment, they kind of fall off. They're not counted, but the reality is they're still unemployed. So there's a lot of stuff in here that obviously makes for this data collection is imperfect at best. And then today, and Cindy mentioned, I like to time these market updates so that the majority of this information is already out. We had the CPI inflation report this morning. Headline was up 0.1. That's not great, but it still met expectations. We were at 0 the month before. And again, the core, which again, Fed's going to pay attention to the core. We strip out the food and energy, was up 0.3 and was, it was 0.2 last month, and year over year remained flat at 4%. One notable thing is the shelter costs, which have been very inflationary. And that's your rents, that's lodging away from home. So think hotels, Airbnb, and things of that nature. And one can only think that, hey, there's probably a little spike in that lodging away from home around a Thanksgiving Day holiday that's now reflective in these numbers. And we're likely to see again a kind of robust shelter number when we get to January, and we're looking back at this month with the Christmas holiday and people traveling and staying places and things of that nature. And then tomorrow, big day, the third shoe to drop. We had the PCE, CPI, and now Fed meeting tomorrow. The general consensus is that the Fed will hold. They will not increase their federal funds rate. They are definitely seem to be taking a wait and see stance, but already speculation in the market and investors, they're expecting that the Fed will begin their cuts. If you asked me a month ago, the sentiment was that they saw the Fed cutting the middle of next year in June. That sentiment now with some of these numbers, their people are betting that we see it even earlier, maybe even at the March Fed meeting on this coming year. So it remains to be seen. Here's what I expect. Again, they won't do anything with the federal funds rate tomorrow. I would expect them, and this is kind of my concern for rates, is if he comes out tomorrow, and by he I'm talking about Jerome Powell, the Fed chair, if he talks the tough talk about higher for longer, which has been their narrative for so long, and the fact that they don't seem convinced that things are moving in a favorable direction, that could put some jitters in the market, and it could cause some negative fluctuations from our perspective, negative in that mortgage-backed security. And again, we'll see tomorrow just how strong that 200-day moving average is, and see if that holds. Any questions on the market stuff? Use the chat. Feel free to unmute yourself. Things are trending in our favor, though. Like I said, that you go back a slide, that uphill climb that looks good, right? That looks good. All right. So let's locally, for those of you in the Northern Virginia area, these reports, your NVAR median home price just up, updated at 670, was up 3.1% year over year. Now total sales volume obviously is still down at 5.6. Prince William, the PWAR median price was $506 and $2. That's up 6.5% year over year. Total sales down 11.1. And the Dulles region, the DAR median sold price was down. This has kind of fallen in average. Was up above 700,000. Now we're at 665, but up 1% year over year, and total sales down 16.9. Right, there's no big secret to this for us. That in the industry, we know sales are down, the transaction numbers are down, but we also know that inventory is still remarkably low, and therefore that's helping to keep prices stabilized and on the increase. Any comments, anything that you guys are seeing or sensing or feeling in the current market? Again, remember, these numbers are always looking back. So, you know, I think we've seen, I've seen an increase just in mortgage application activity, since the beginning of this month already. So, you know, when people hear that the rates are coming down, those of you that have been here, we're talking about that tsunami of buyers that's just waiting on the sidelines, and we're looking for that sweet spot. And we'll talk some more about that sweet spot here in a second. All right, so lending, news on the lending front. I kept a couple of the financing options there over on the right-hand side that I had on last time about, low down payment assistance programs that exist. But this stuff over here on the left-hand side, kind of hot off the presses. 2024 conforming loan limits announced, right? So the standard conforming loan limit, I'm sure you've probably gotten email updates and stuff like that on this. We went from 726,200 to 766,550. And since we in the DC area are a high cost area, that has gone from 1,089,300 to 1,149,827. Kind of, when you think about it, it's like, wow, we're like 1.15 million is going to be get kind of, in a way, preferential interest rate pricing in high cost areas like ours, right? So that's again, we expected that there would be another jump up with the way the prices are going up. And now what it means is, hey, these people that can find the home where their loan amount is 766,550, they're going to have a crack at the better rates. And it's nice that in this high cost area we have that second level tier. And most areas, you have to keep in mind, don't have that. And you'd be surprised that some pretty big metropolitan areas aren't considered high cost, right? It's not in Philadelphia. If they go over that after the first, from now through next year, if they go over that 1.149 million, then they have to do jumbo financing. And the trade-off with jumbo financing is it's pickier underwriting, higher reserve requirements, and typically higher interest rates. VA, FHA, and USDA, they follow suit. The important thing to remember, if you're courting anybody that's FHA, though, you can't have an FHA case number pulled under these new loan amounts until January 1st or later. VA loans, you can originate, go under contract, all that stuff. You just cannot yet. If you're going to operate under the new increased loan amounts, that closing must take place after January 1 or January 1 or after. All right, so that means the jumbo floor will go to 766,551. That's typical. That'll always be $1 over whatever the conforming limit is. And super new news that's not in effect yet until this Friday on the 15th. For those of you in Virginia Housing is increasing their maximum loan amounts and sales prices along with their income levels. So for the DC metro area, they've increased the price, and I think it's currently at 665,000. Well, that's going up to 725,000. And for those of you that know Virginia Housing, these income-based programs are always dependent upon how big's the household, who lives in the house is 18 years or older, and generating income for these income calculations to make sure that they're at or below the limits to be able to do these programs. The standard limit for 2 or fewer is going to be 171,000 in annual income. The grant program, which is always lower, has a lower cutoff. And again, it makes sense, right? The grant is no strings attached, kind of gift money from the state. So they obviously want that to serve the people that are in more need of it, your low to moderate incomes. So that's at 137,000. Now, for households 3 or more, the standard's going up to 200,000 in annual income, and the grant limit goes to 160. So it's good to see that, because we do recognize, we know that the incomes in this high cost area have to be high for these people to be able to afford to live, whether it's renting or owning a home. And it's always good that Virginia Housing is continually reevaluating this and updating, because all these loan limit increases and increasing the cutoffs for the household incomes on these first-time homebuyer programs, it just gives more and more people an opportunity to get into ownership. The FHA 100% with down payment assistance, and the conventional 1% down, no PMI. I had that on here last month, but those are great programs. And what's great about the FHA one is, unlike Virginia Housing and some of the other state programs, there's no income limits. Obviously, we just have to make sure that they meet debt ratio and other FHA guidelines. The conventional 1% down, it's a little bit tough as we creep up in price in our area, because the maximum loan amount can be $350,000. Those of us that, if DC is the bullseye, the closer you are to DC, the more of you know that's just, that price it's not there, right? Or you're limited to the condo world. But a good program nonetheless. From a national perspective, without a doubt. And it's like, again, it's a no PMI, 2% grant. And it is one of those income-based programs where the borrowers, the qualifying income on the loan has to be 80% or less, regardless of the number of borrowers. Any questions on the loan stuff? All right.
I have a quick question about no PMI.
Yeah.
From a general perspective, a client who may say, "Oh yeah, I'm looking for that no PMI loan," I'm not convinced that that's something that's like always available. Like, how do I explain to them that, what that usually entails, requirement wise, perhaps?
Well, in particular to this program, this is standard Fannie Mae loan guidelines and rules to play by. Now, what I will tell you, behind, the one thing that, if you haven't been told this before, no PMI is always been an option. But most people don't tend to move forward with a no PMI loan, because the PMI, it's really there. It's just built into the interest rate. So on a program like this, you can expect that the interest rates are going to be above market. By how much? 3/8, 0.5%, probably at a minimum. Sometimes they're a point higher. Market conditions kind of dictate that, and rates are a daily event. So it's hard to really pinpoint. But that's the way no PMI works in general, right? If you've got a loan program being advertised as no PMI, that borrower can expect that, they're going to be above that national average for interest rate when they get numbers from the lender. So, I'm always upfront and transparent about that. And no PMI has worked for many, many borrowers of mine in the past. And sometimes there's a time for it, or sometimes there's a borrower specific scenario for it. And it does exist. And like I said, it can be, it's oftentimes included with a lot of these first-time homebuyer incentives. Right.
That's very helpful. And I guess it's definitely got to be a conventional loan, period.
Yes. Yeah.
Okay.
Yeah. FHA's monthly mortgage insurance premium is non-negotiable. Yeah.
Got it.
It is what it is. Yeah.
Very
Good
helpful
question.
answer. Thank you.
You're welcome. Anybody else have any other questions? All right. Well, let's talk about unlocking the lock-in effect. We talked last month. I plugged some slides in here to get us to think about some of the problems that we're facing. And, here are, the top 3 that's really been a thorn in our side. And number 1 there is sellers not willing to trade a 3 handle rate for a 7. right? And what this has created is the house hostage term that you've heard me use. And two examples of that, boomers stuck in, stuck in their homes when they'd love to downsize. But they're also caught like, hey, there's no inventory out there for me to make this move, for me to be, aggressive enough to list my home for sale. And, and if they have to finance that next house, yeah, they're probably like 63% of the people with a mortgage and have 4% or less. So 7, and when we peak there at 8%, that's a pretty tough pill for these people to swallow. So we know what they do, right? They say, well, I'll just wait, right? I'll just wait. And again, it's kind of created this, a bottleneck of these trapped homeowners, if you will. Obviously, the rate's going to 8, right? Push the buyers to the sidelines, and then the housing inventory remains low. Prices continue to rise. And that's where, with this improvement, and so the question is now the sweet spot? So I included there a little infographic that was on Brian Buffini's bold predictions for 2024 yesterday, if anybody tuned into that. He had this top 10 reasons why people are moving in 2024. And it's a really good list for us to keep in mind, right? And the number one reason there was family ties. And this really started and kind of exploded with COVID. People wanted to be closer to family and aging parents and things of that nature. Number 2 is the need for a bigger space. We're always going to have the households that are growing, and they're always going to be on this list. And you've got a lot of people here at number 3 right now, right? They love the rate, but not the house. And again, they're the house hostages. They're the ones that are just sitting, and they're not anxious to trade up, in a higher rate environment, despite the want and desire to have the bigger space for their family. You have people that are looking to upgrade neighborhood, and that could be getting into that's better play, better neighborhood for schools. That could be closer to work, right? There's a high population out there that are always going to be looking to kind of upgrade the neighborhood for whatever the life need is. 5 want a vacation home. I've had more second home and investment property inquiries in 2023 than I probably have in years. And it's part of me is thinking, hey, did you kind of missed the boat when rates were, kind of ridiculously low with 2020 and 2021, when everybody was picking up these properties and everybody wanted to be an Airbnb landlord. But it's not just the Airbnb. You've got, since COVID, you've got people that can perform their jobs remotely and work from home. So there was this big influx, and it's going to continue, of people wanting to get that second home in a place where they have the flexibility of like, hey, I'm a mobile worker. I can go there. It's a warmer climate. Maybe it's seasonal, and I can still work from there, right? Yes, you're still going to have your, hey, no, I want to get this investment property. I want to rent it out long-term. I want to Airbnb it because it's, in a desirable vacation area. They still exist too. But what I've had recently is a lot of thoughtful kind of forward planning thinking of, I'd arguably say the age demographic of between 35 and 45 years old, that are really getting serious about finding a second home and making a move on second home now, with all the intention of that property being their retirement home in the future, right? So we had a bunch of inquiries, and I've had a lot of conversations around that topic. And it's kind of a smart move. They think, hey, what are the house prices going to be in 15, 20 years when I do retire, right? Well, can we get this now right? Get this now, know that I have the opportunity to buy, buy now, refinance if the opportunity presents it when the interest rates drop, but it's secure the real estate and the property now. So a lot of that going on. 6, lots of equity, lots of choice, right? We have home equity at all-time highs. We've got a lot of people. I just read something 26%, I thought, 20, 26, 23 or 26% of homeowners are free and clear on their, on the properties that they live in, on their primary residence. Right? That's a lot of equity. That provides a lot of choice. And again, it's being in front of those people for when the time is right for them to utilize that equity, because that's your next listing. And maybe they don't need a mortgage the next time because of all that equity, and they can just, pay cash, especially the boomer population that's looking to kind of find that retirement home. Legacy real estate, kind of in the same vein. We're talking about the boomer population. We have more people now. And I see it almost, it's probably on, I'd say 75% of the transaction I've done this year on purchase has involved some type of gift money, family gift money, parents and grandparents helping the kids and grandchildren get their foot in the door to owning real estate. So kind of it's a legacy real estate. We're always going to have that, family members helping other family members to get into the game. Number 8, another good boomer right time to downsize. They feel trapped right now. Inventory's not great. Rates aren't great. So they're stuck. And then always keep in mind your out of area relocation, especially, I'm sure you guys and through your real estate shops probably have a network of referral systems and things like that. You might help them sell this house, in your area, but they might be relocating to a different state. Always check what your relocation and referral sources might be to continue to kind of serve those people, even though you physically location-wise can't do it for their next move. And then there's always going to be a change of work, change of life, job change, the household makeup changes, right? The family grows and the space gets smaller. All these were really good top 10 reasons. And when you think about if you think one thing I was thinking about and that was talked about in the Buffini thing yesterday was the target marketing that could be done to the people that fit into these boxes in this list of 10. And coming up with data, research, something topical that maybe you can send to your past clients, and information and things of that nature that you can provide to your new prospects. Always something to keep in mind. So when we think about, is this the sweet spot time? And the reason for that, and I think early adopters are going to see a really big opportunity here, but they need us to communicate this to them, not the media, right? The media is scaring them to death. There's a lot of potential here. So 2 questions when you think about it. If you're thinking about sellers, right? Because we don't have enough sellers right now. The question to pose to the potential sellers, do you want to wait till rates bottom out? Number 1, have fun timing that, right? Now, if you play it right and it happens, and you list your home, that's great for you as a seller, right? We've seen it for the last few years. Selling the house isn't the problem. But when you go to buy, right, if the rates do bottom out, all the buyers are coming back in. So if you wait too long, if the sellers wait too long, then when they're on the buyer side, it's going to be 2020 all over again, bidding war and overpaying for the home. So things to get them to think about. The second question here is, the challenge, if you will, is, do you want to be an early adopter? List the house now while rates are coming down, sell the home at a fair price, then buy the home you wanted for the past few years at a fair price without the bidding war and get a fair interest rate in the process, right? we're not in the eights today. We're back to 7. I've been quoting in the mid to high sixes in the last couple of weeks, and it's kind of been nice, to be able to communicate and but also to paint the picture of like, look, I've told these people I've talked with in the last 2 weeks, I said, look, we're having this conversation at the middle of October. This is a drastically different picture. It doesn't look good. Maybe these people don't qualify. So just some things to kind of think about as you wrap up 2023. I know there were a lot of thought-provoking things in that bold predictions presentation yesterday, and this idea of target marketing to get people, off the fence and to have them make a move, and more so, like I said, to help you guys as agents to generate the listings that the market desperately needs. So it's pretty simple. You stay in touch with your people, reach out to them. The number one complaint we hear, I hear agents say all the time, hey, my number one problem is I stink at client retention. And the number one complaint of the homeowner is, when they go and they use somebody else for their next purchase, when they're polled and asked why didn't they use the real estate agent they used the first time to buy the house, they said, well, I never heard from them. So a lot of this is just basic staying in touch. And it doesn't always have to be about real estate. You're staying in front of them just by reaching out and, chit-chatting, catching up, non-mortgage, non-home related, just check in, how you doing, staying in front of them. It's not a big secret on how to do that. Birthday messages, we're obviously around the holiday times. It's always a good time to reach out and wish your database a happy holiday season. Any questions, thoughts on this stuff? Anything here that, hey, I didn't come into this thinking about this, but that's the goal here, is to give us all something to kind of think about, and how can we grow our business, but all of this is, with a servant's heart at the core, and helping people and getting them into home ownership where they can build some long-term wealth. That's the goal. Questions, comments? Quiet group. Uh-oh, it's crickets out there.
There's a chat. Do you think rates will stay flat into the summer?
That's me, Mike. Bill.
Hey, Bill. Yeah, I think I do think we're flat. Flat is good. I would say flat. As I said before, it's never linear. And yeah, the thing that took me the longest time to realize when staring at those candlestick charts is that there are underlying fundamentals. There's always exterior things like wars in other countries and stuff that'll trump that and rattle the US markets because we're so globally connected. But I do think fundamentally, in the technical aspect of where mortgage-backed securities are, and I do think the Fed is done. I think they're done with their rate increases. I do think their hand's going to be forced into cutting rates in 2024. I don't know if I'm completely on the bandwagon that we'll see it as early as March, but I do think by mid-year. So your question about, do we stay flat till the summer? I think there's a really good, I do think everything's indicating that. It's the black swan event that always makes me nervous, right? But I think that I do like, and I like that word flat. And what I was telling the buyers and in the conversation that, you know, the prospects that I've been in contact with is, you know, and past clients too, that bought, you know, a year ago, and they're waiting, when will I have a chance to refinance this? Is that it'll come, but we need this gradual. If these rates bottom out, we got worse problems. We got worse problems. So I like the trend. I do like the trend. Ashok, what are your projections for 24? Lots of first-time homebuyers on waiting list, and they think rates will go down. Yeah, that's tough. You know, I was just talking to a buyer the other day, and I said, I remember, because it just sticks out to me, that in February 2020, rate quotes on the 30-year fixed, I remember quoting 4 3/8, 4.5. And at the time, they were trending upwards, right? And then the next month, everything shuts down. The Fed jumps in. We have to educate this first-time buyer that's on the sideline that was abnormal. That was deliberately on purpose low rates. And there's more, I guess, if a buyer said, well, I'd like, you know, I want to wait till rates get down into the 5s. That's a little more realistic compared to the buyer that says, I want to wait until the rates get back down to 2 3/4. That was super deliberate. They were artificially low. I'm a never say never guy, as well, because you don't know what the next catastrophic event might be where they have to make borrowing money look really attractive. But betting on that anytime soon, I just think you have to kind of talk to them about the facts and say, look, here's where things were. And the reason why they were low that long really didn't have to do with the technicals of the market. It had to do with a global pandemic and, you know, and keeping things operational and keeping business afloat in a global community. You know, 24 being election year, you know, that's hard too, Ashok. It's good. I mean, it's all, you know, I just read a headline this morning too that said, you know, inflation numbers trending well, interest rates seem to be coming down, and a Fed that's likely to cut next year could bode well for, you know, Biden's reelection, right? That was the headline. The media is going to run with this. I'm going to, and it's not that the investors and the markets can't be influenced by global and geopolitical stuff. We've seen evidence that it definitely can, you know, play a role. But I would err on the side of the technicals of the marketplace more so than the election. But again, it can't be ignored either, right? It can't be ignored. But I don't think it's the driving force. You know, I look at it this way: regardless of who might be in office, the change that the change that anyone might be seeking will be slow to happen if it happens. And I'm not trying to be negative about politics. I mean, you know, we've heard people, campaign for years on promises. And you know, I don't know, me individually in my middle class world, I don't know if I've ever really benefited from either, you know, regardless of what the politics is at the time. So it'll be interesting, but it's and I think it's going to be topic, right? How's the market doing? Because if the market's doing bad, it's somebody's fault. If the market's doing well, right, somebody should be championed for it. So it plays a role, without a doubt. Good question, tough one to answer. Anything else?
Yeah, Barbara has a question. Her hand's raised.
Oh, I'm sorry, Barbara,
Yeah.
go for it.
Thank you, Mike. Good presentation. A
Thank you.
question for you. You know, we
Yeah.
got the buyer broker concierge here. I've been around for almost 40 years, so now we got to dance back to where we were, work for it. So, like in a niche market, if you was to choose, what would you be as what would you put as a stimulus that you're connected, that knowledgeable, and that you got, this market that would, something that one of the programs that you were sharing with us that would be a good stimulus to kind of draw. What would be that branding that you would try to throw out there?
So are you asking in particular about like for example, like the first time buyer stuff?
Yeah, well, that's good. Yeah. Because first time buyers is 500,000.
Yeah, yeah, and they're like I said, they are percolating on the side right now. Another part of that presentation was the household formation and how home building is not keeping up with household formations, and then birth rate, and you throw that into the 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 age range for these millennials, and they're coming into their home buying years. So, it's here's the thing, the programs themselves, it's all a 30-year fixed rate loan. And it's good that we have these programs to help people get into their first home with the assistance. But as far as kind of I always do my thing based on the need, right, of the particular borrower. And that's you can get pretty clear on that if you ask them the right questions when you're, in your initial consultations with them, because then that kind of drives what products in terms of financing might be best for them. And yeah, I mean, these first-time homebuyer things, the
Well,
program.
yeah, I was actually speaking along. I appreciate that answer. I was speaking along, like capturing the leads, something that would stimulate them. It's a different market here today. So you either got them afraid to move out of their house or thinking that the interest rates are going to drop down. So in speaking to them, like, being the concierge, that you got all the connections, you got this together, you got to stand out, you got to make yourself exceptional. You can't just run along with the pack anymore. So with that, what would be what niche do you think that would be, I saw you. Oh, here's a question that I wanted to ask you too. Are you seeing more families buying together? Like the couple of generations, going back to buying together. You seeing that? Is that one of the things that's being?
Some of the multifamily buying, not a whole, me personally, not a whole bunch.
Not a whole lot. Okay.
Yeah, yeah. But to answer your question about how, to me, it seems like you're asking, how do we get the word out? And I'll go back to
there's something that's unique, something that's, oh, wow, okay, let me do it. There's got to be something, I mean, these are good, but like if you had the chance, if you were out here hitting the street like us, what would be your niche? Like looking at your programs.
I think it's one of those things where it's picking up the phone to make the call to the past client, check and do the check-ins. From a mortgage perspective, I can tell you something that I do. I do annual mortgage review.
Oh.
So let's flip that to the real estate agent, right? Are you doing an anniversary reach out call or marketing piece to the people that you've helped, buy the home last year? And as the more and more I do this, the more and more my calendar gets filled with little reminders that, hey, it's so and so's second annual mortgage review, third, they're starting to fill up, which is great. But I look at that as an opportunity for me to get in front of them, and because I'm sending them a report that when they click on it, I know they've accessed it. And I've embedded, my software allows me to embed a video of it, and I shoot them a little message. And obviously my message here in the last year has been, hey, it was great. You bought it, you bought at a great time, because there's nothing out there that would beat the financing that you have in place right now. But I'm not getting a transaction out of them now, but I'm hopefully staying top of mind. So that's one thing. Annual reviews, I do birthday messages. Think of these, one of the things that I'm thinking with this top 10 list here is, just something quick, little marketing piece. If your companies have, marketing departments, or check with your lender partners and things like that. And we have a great marketing
Well, see,
department.
I'm an AI instructor now, so in prompting, this is what I was looking at. Would you choose to be a perspective of, that you could put out there as a good stimulus to land some of those um, leads that you're talking about. Yeah.
You're saying with the use of AI?
Yeah, well, yeah, we're prompting some of this into AI to be able to get
Yeah.
something to go back into the families, to go back into the homes, and to reach out for the captivating the market. Mhm.
Yeah. Yeah, I'd say any marketing piece, and story selling is big. I'm starting to work with our marketing department, basically kind of a sketch, if you will, of some info videos that I want to kind of put out on, and again, telling the story of a family in a situation where I help them. Right. And it might be first time buyer. For me on the lending side, it might be, hey, we did a cash out refinanced and got them out from underneath consumer debt and into a better cash flow position.
Excellent.
Things of that. So you like, whether that's in print or video,
Mm.
and Cindy will say this because we've been talking about it. It's like video, but there's so much truth in that it comes to, we're getting to the time with New Year's resolutions coming up. I want to do more video. I want to work. I have this marketing department here at this company that I don't even think I've really scratched the surface of utilizing them to their fullest potential for what they could put together for me.
Hmm.
And
So
I
what you're
wanna-
saying,
I
Mike,
wanna
good
do that.
stories, good strong stories that would
Yeah.
actually fit into their categories in certain areas. Good stuff. I like
Yeah.
it. Mhm.
Yeah. So, and if I think of it, I forget the name of the full title. There's a really good professional read, on story selling, that, when I send the slides out, I'll throw that title in the email.
Yeah, do that. Yeah, because that's good. I believe facts tell, but stories sell.
Yeah. Um,
Thank you.
Another question, how often should we be contacting them? What can we do to get some of their family coworkers? So here, good question, right? How much is too much, right? Where the last thing you want to be is like spamming your people, right? Which I think, that's where some people that subscribe to marketing programs, sometimes it's like a monthly thing where it's an email that goes out, or it's an email that they put together themselves, or a newsletter. Once a month isn't a bad idea for touching them in some way, shape, or form. I don't call all my past clients on a monthly basis. We don't, I don't have time to do that. I try and do them around those important things. I'm real deliberate about a quick little birthday video message through text. My clients love that, and it takes me all of 12 seconds to do it, right? Giving them something of value and education on a monthly basis, I think it's fair. I mean, that's kind of always been my goal and aim, is to have me in front of them in some way, shape, or form once a month. But pay
I sent a
attention.
nice little description here. Guys, we do all this business building stuff. Go attend it. You will learn a lot. And a lot of it's around the things that Mike's talking about right now. It's always under cindybishopworldwide.com to upcoming events to webinars. And, we put them in, we have them a handful of times a year, and you'll see them there. That's where Mike's market update is too. So use the website.
One real quick thing is show what can we do to get some of their family coworkers information so that we can also educate them. Well, I don't have a direct line to you getting those people's contact information, but the starting point is, calling them and simply asking, right? But obviously in a non-snake oil salesman type of way, right? We're calling to check in on them, see how things are going. And sometimes maybe the purpose of the call is, hey, I want to call this particular past client, and do it around this. I just went to a coaching training yesterday where they talked about calling, and essentially you're calling your past clients for help, right? You're not trying to get a pity party, but what you're trying to do in the context of that conversation is really, in a nutshell, you're calling saying, hey, I loved helping you buy your first home. And when you say that, you're going to bring back, provided it was a positive transaction, everything went well, right? You're going to get a gratitude response from them most of the time, right? And it's, hey, I loved helping you. And then there's going to be some kind of thank you on the other end of that. And then you follow and now and then you're flipping it to say, I would like your help with something, or I need your help. So you're saying, hey, I helped you. It was good, right? Now you're asking them, and that's where you go into like, hey, you talk about how great of people they were. I want to work with other great people just like you. Is there anybody in your circles, family, friends, coworkers that who might be, and this is where you come a little renting or already own a home, who I might be able to help in the future? And if so, I'd love that introduction. Right? Most people are going to say, I can't really think about anybody at this time, and that's okay. But usually what they say is, hey, when I come across them, or when I do, I will make sure that I connect them to you. And that's what we need to hear, because confidence is part of this. And even if we hear that, we don't get a particular name and somebody to call that day, right? We're doing a check on our client, right? Do I have this client? Do I still have this client's trust? So yeah, like I said, it's not, you're not calling begging, right? It's got to be constructive in nature. But that's just on a training that I just did, and I thought that was worth knowing.
All right, guys, it's time to go bye-bye. So thanks, Mike. Wonderful, wonderful training.
Awesome. Thank you.
Thank you
Thank
very
you
much.
very
Thanks,
much.
guys. Happy holidays to everybody. See you next
Yeah,
month.
be safe. Happy holidays.
Take care.
Good.
Bye-bye.
Have a great